Thank you. Thank you. Good morning, Roberto. Thanks for joining us today. Can you start by talking a little bit about Investindustrial and how you're thinking about incorporating sustainability into portfolio companies as a private equity firm?
Absolutely. And we have an easy task after the panel we just heard. But look, sustainability for us is part of our strategy. And we have the strong conviction that sustainability and delivering superior returns for our investors go hand in hand. And I'll explain in a minute. But before we go into that, maybe helpful to give a bit of background on the company and where it comes from, how it operates, and so on. So today we are one of the leading investment groups in Europe. We have more than 12 billion of raised capitals, 170 professionals around the globe. We were founded in 1990, but our origins comes from an industrial conglomerate that has more than 100 years of history. So an industrial conglomerate, which was a family business, which was founded in the 1890s and throughout the 20th century was managed as with the typical characteristics of a family business, which is empowering workforce, thinking about energy efficiencies and efficiencies how you consume resources, thinking about how you drive your competitive advantage through innovation. So thinking about how you make sure that your family groups continue to thrive in the long terms for generations beyond yourself. And that's how Investindustrial today is managed. We have the conviction that in order to create better returns, the returns that we create comes from, yes, financials, increasing profitability, but comes also from how a company is valued at the time we exit. And how a company is valued is a company that is more sustainable, is a company that can compete better independently on the macro environment. It's a company that invests in its people, because that, as Stancy showed us in the example of Amazon, effectively allows to retain people, train them, having a more engaged workforce. It's a company that reduced the carbon footprint, but reduced the carbon footprint because that has a real impact at the end of the day also on the bottom line. So it's a positive circle.
Can you give us a couple of examples?
Absolutely. So, well, let's think about what we have faced in the economic world over the last 12 months. Europe, energy crisis after Ukrainian war. Suddenly, the gas prices increased by 5, 6, 7 times compared to before the war. We have invested extensively in companies that has important industrial footprint. If you invest in those type of businesses and you have sustainability at your heart and you have invested to make sure that your energy sources are from renewable base and you invest in your own operation in order to have your own solar energy production through photovoltaic panel, solar panel, at the end of the day, your cost of energy is lower than your competitors. You can serve your customers better if you're a B2B business because you don't need to increase prices as others have done in the industry because of energy inputs. With that policy, you have reduced your energy emission, but effectively you have supported your financials, your EBITDA, you have created value for your customers, and you have created a more sustainable business that is more effective also from a financial point of view.
So you're talking about efficiencies. If you can reduce energy usage, it helps decarbonize and save money at the same time.
Absolutely, correct. That's an example.
How do you think about this internally as a private equity firm? Private equity firms in the business of making money. How do you see this as a competitive advantage, and how do you think about it as part of corporate governance at Investindustrial to begin with?
It is part also of how we manage ourselves as a firm before entering into how we help businesses to be managed for investors. Sustainability, in order to be a successful investor, you need to embrace those principles within our own organization. So when you think about governance, when you think about social aspects for our own firm, our own GP, engaging our own people, making sure that we retain our professionals, making sure that we train, making sure that in the decision-making process that we do regarding businesses, regarding the growth of the firm in the long term, we embrace the sustainability aspect as a key part of our strategy. At the end, our view is that those decisions will be better decisions that makes a better firm in the long term. So, that allow us also to perform better for our institutional investors once we engage on our funds.
So you see it as a competitive advantage?
Absolutely.
When you're looking at portfolio companies, either to invest or ones that you have under management already, ESG presents risks and opportunities. What are some of the things that you look for when you're looking at ESG risks and opportunities?
First of all, we have years ago created an internal sustainability ESG team. So again, to be on the forefront on the investment side, and so going and due diligence on investments, you need to make sure that you have the capabilities and the resources internally to do it credibly and effectively. So we invested in our team, and the sustainability and ESG due diligence is a core part of our due diligence when we enter. So when we look at a company, yes, we analyze the markets in which they operate, we analyze the attractiveness, the growth of those markets, we analyze the competitors, we analyze the strategy from a financial and operational standpoint in those industries, and concurrently we're analyzing what is the carbon footprint on the company that we're going to invest. What are the environmental decisions that have done throughout the years that have positioned this company into that industry? How does these companies treat the employees? What has been the turnover, going back to Tensi's questions? What's the diversity and inclusion policies of these companies? That gives us a very good understanding of, one, do we want to invest in this company or not? Because there are situations where the risks from an ESG perspective are too high, so we don't want to engage. But most of the time is, how can we put in place a successful plan from an ESG point of view that creates a better company over time, a more sustainable company, hence a company that by the time we exit will deliver a better return for our own investors. And so everything starts with due diligence, everything starts with data. Then we go, the moment that we've done our investment, we go into the execution of the value creation plan with management, putting KPIs as similar to as we do from a financial point of view, and rewarding the whole organization for the achievement of those KPIs. And then effectively, when we move into the exit phase, it is about showing that as we have created a best-in-class organization from an IT point of view, from a people point of view, from a product point of view, we have a best-in-class organization from an ESG point of view that deserves a higher valuation at exit.
You talked about rewarding on KPIs. So can you talk a little bit more about that and how you help portfolio companies improve on sustainability? Julian was talking on the previous panel, everybody's on a journey. How do you help them improve and reward for that improvement?
So management in our portfolio companies is rewarded also in terms of sustainability goals. So when you look at our compensation package of our leadership teams, and then it goes throughout the organization, we have KPIs and compensation linked to the achievement of those KPIs throughout the investment. In terms of how we help them by working together with our sustainability team on a day-by-day in making sure that the things that we identified at entry as potential opportunities from an ESG point of view are captured. And we make sure that the strategy evolves years after year and it improves in order to be more sustainable and more effective. I'll give you an example of one of our portfolio companies, Jacuzzi. Jacuzzi is a Californian-based business, originally founded by Italians. As you know, they produce hot tubs. And when we were in due diligence, one of the analysis that obviously we did was on the carbon footprint on the company, and the reality is that 90% of the carbon emission of that company actually comes from the use of the product by the consumers. So when we think about how do you change the ESG approach, is also how you incorporate ESG and sustainability within the strategic development of that business. So that business incorporated by effectively moving R&D on the product development side in making sure that the company was going to create more effective, better energy efficient product for the benefit of the consumer. And then guess what? Again, we go into the energy crisis, energy becomes a more and more compelling issue for a consumer when they need to buy the company, they need to buy that product. Hence, Jacuzzi becomes a much more competitive in that tough environment vis-a-vis the customers and with the other products of competitors, because the ESG became part of the strategy. Product development was evolved in a direction that was more sustainable over the long term, and then that becomes a competitive advantage from a customer point of view vis-a-vis how to create value over time.
So you're saying Jacuzzi was in hot water for its hot air?
Exactly.
Well, can you elaborate on that? I've got to imagine there's some difficult conversations that come up in this cost for these transitions. How do you talk about that, especially with owners? I mean, I got to imagine that, yeah, this can be a challenging conversation. You talk about how you manage that and how that can help the portfolio companies.
I would say we invest, a significant part of our business is investing in companies that were family owned. And sometimes when you meet with founders and entrepreneurs, especially when you invest in the smaller companies, sustainability was not on the priority of their list. The way how we win the confidence of those entrepreneurs is to show the positive impact that we have had with other businesses and how at the end, moving the company and the strategy in a different direction and helping with the resources that we have internally allows those companies to be more successful in the long term in a way that they were not used to. And so when you think about, you spoke about cost. We like to speak about, again, investments. Think about technology. Assume that you invest in a logistic company. Logistic companies where the service rate is low. What everybody would do is you invest in IT to put in place a warehouse management system. That would be considered not a cost, but an effective and successful business decision in order to improve your service to customers. When you think about ESG, is a complete similar approach. The investment in photovoltaic panels is not a cost for us. It's an investment that supports the successful evolution of a business. So you invest in Tensi was speaking about the work that she's going to do on medical device and healthcare. Medical device, we are currently investing in a platform on medical device. You typically deal with OEMs that are more and more outsourcing to third-party manufacturing because they're becoming sales and commercial organization. And so you think about what energy efficiencies from that perspective brings to the table of those OEMs. For those OEMs, having a partner that invests in reducing their carbon footprint, hence having a clear input cost on energy, allows them to have a clear visibility in the long term of what the cost of those medical devices are, hence can go to hospital communities with a clear vision of how can serve on those medical devices. That's a clear benefit from a business point of view that moves the perception of the investment in the photovoltaic panels from being a cost to being an investment for the successful positioning of that business.
Do you feel like in the private markets, you have the benefit of time for those kinds of conversations, whereas public companies, which have to report for shareholders every 3 months, it's harder for them? Is that something that is that a sort of asset that private markets have in fostering this type of development.
Absolutely. And I think it's, unfortunately, a strategy that would be typically done in a portfolio company, but a successful PE would, in the first years of investment, be strongly penalized by capital markets, because the attention on the short-term EPS of the business does not allow management to take in the short terms the decision that are substantially beneficial to that company in terms of long-term development. And when you look at private equity, even if people sometimes accuse of the short-termism of private equity and the fact that at the end of the day, private equity has to sell the business, the reality, because when you sell the business, the value of the business is based on the long-term success, we have a view, and we have the beauty of having a view that is much more long-term, independent from the short-term impact of decisions that we take on the businesses.
I want to ask quickly about the regulatory dichotomy between the EU, Europe, where you're based, and the US, where certain states, as the previous panel was talking about, the ESG is a backlash, whereas in Europe, ESG is just now investing. Can you talk about how you're thinking about that?
At the end of the day, we have, around 50% of our investor base is from the US, and has been consistent for the last 3 decades. And our institutional investors care that we are sustainable in the long term, and we are able to deliver superior returns consistently, independently on political environment, macro environment, and so on and so forth. So the way how we continue to operate is making sure that we do our job day after day, and we incorporate those sustainability decisions into our own processes and value creation, so that people don't see a disconnect between financial performance and sustainability and investments there. And I must say, despite what we just heard in the previous panel and the public attention, I think is really true that what's going on within the company, without outside of the spotlight, is substantially stronger, higher than people see from the outside. And that's really how we are managing with our investors. So we have absolutely no pushbacks and no different dynamics between Europe, our European investors, our US investors, with regards to what we're doing and the value we create.
I think just briefly, and something I hear a lot is that efficiency dynamic that you talked about resonates well. I was talking with a private equity firm just the other day about they're operating in a very Republican school district, and were managed to able to reduce their energy costs, and it's a decarbonization play at the same time, but they see it as a cost savings that they can deploy dollars to paying teachers more. We'd like to take a couple of questions from the audience, if folks have any questions for Roberto. We have a couple minutes.
Prime Minister Modi's set a 300 gigawatt goal just for solar, another 200 gigawatts from the other renewables. As I mentioned earlier, the IRA forecasts for gigawatts impacted range from under 200 to over 450 gigawatts. How does your company look at those two numbers and say, what should we be doing in terms of investment? Because to get Modi's number, you have to do 450 500 megawatt projects, 8 a month, every month until 2030. There's only 2 or 3 500 megawatt projects in the whole country that have been done ever. So how does that get reconciled?
Look, we always look to investments bottom up. So we look at how we can create value in the specific investments given what we have in our hands as we start. And already if you look at installing solar panels within your own facilities, in our experience, already that typically covers between 30 and 50% of your energy usage for most of the companies in which we invest. So we start from there, and then we assess project and push management to assess project as we go, as we typically assess the return on investment of any other project that regards investments in R&D, investments in IT, and so on. So we think that that's great. You know, in order to be sustainable, you also need to make sure that every single project delivers value to your own organization, and that's what we try to do, independently on the big number top down that obviously, rightly so, people engage with.
One more question? Yes, please, in the front. Try it again.
Sorry about that.
There we
so
go.
I was reading a report by McKinsey. I don't know. I know that you should take some solar grain when you read McKinsey, but they said, well, I mean, they want to make it rosy sometimes so that they can. Anyway, they said that to reach net zero by 2050, there should be about $275 trillion of investment. And they said that maybe about 180 million jobs will be lost in transition. So do you think the world is ready to spend that kind of money and to take that kind of risk? In a bigger scale, I mean.
There is a lot of capital out there. So that represents huge opportunities for people like us in the industry today. So that's an incredible amount of capital needed. But if we could develop even half of it or a third of it and deploy successfully, there would be a huge impact from an energy and sustainability point of view.
Thank
Great,
you
okay.
so much.